So we'll go to the next pillar. The second pillar is going to be credit and debts, okay? And this is kind of 2 for 1.
Okay.
It's one and the same. How much you spend month to month also determines, where your credit score is going to be, where your credit profile is going to be. So let's talk a little bit about that. Credit itself is a very mysterious topic.
Yeah.
We do know how certain bureaus like TransUnion, Equifax, Experian, they do publish how they weigh different aspects of your score, but there isn't really a formula or an algorithm that we can rely on to understand, how the credit score is calculated. It's all different. Yeah. So you might hear the word FICO all the time. FICO is actually a company called the Fair Isaac Corporation that creates these algorithms and scoring models that then TransUnion, Experian, and Equifax utilize to keep a record of how well you manage debt. Now, I'll start with the big myth is that, I'm gonna get rid of all my credit cards, pay off all my debt, and be debt free, and my credit score is gonna get higher or improve. Unfortunately, so what credit analyzes or indicates is not how well you pay off debt, but it's how well you manage your debt on a month to month. So in order for you to manage debt, you have to have some debt, which is kind of this backward situation that, we're in, but it's the rules of the game. So this is what we have to learn how to play with, okay? Even with FICO scoring models, there's about 10 different scoring models out right now, and every single industry that uses credit to determine a risk factor or to determine any credit worthiness, uses a different scoring model. So for example, if you go buy a car, they'll use a FICO auto score. If you look at Credit Karma or CreditWise or, whatever your credit card company offers as a credit review perk, they use a different scoring model. A lot of times it's FICO 8, 9, or 10. Or you also have this other scoring model called Vantage Score 3.0 or 4.0. So there's so much that is out there. And so a lot of the times people get confused saying, my FICO is X. The correct answer is, that we want to know is what type of scoring model it is, where are you looking at it, So just know that for us as mortgage lenders, we look at FICO scores 2, 4, and 5. Okay, so it's a little bit of an older model that we rely on. And I don't know why, mortgage lenders use those scores. But those are the scoring models that we use. A lot of the times when we do pull credit, there's 2 ways that your credit can be pulled. So number 1 is what's called a hard pull. And when you do a hard pull on your credit, which some lenders will do, you get a ding on your credit report. It will appear as a record and say, hey, on this day, so-and-so pulled your credit. It will bring your credit score down by about 3 to 5 points. Okay.
It's not crazy in the scheme of it, yeah.
However, if you're on the cusp of, qualifying credit-wise, you might need all those 3 points, and 5 points, right? So that's one way of pulling credit, okay? And when we pull credit, we look at your score, but also your credit history as well. Were there any late payments, collections, charge-offs, and things like that? Sometimes people don't even know that they had a collection, until, we pull it and we're like, hey, by the way, were you aware of this situation? And they're like, no. And, when they look at it, they were like, oh my God, that was this car insurance I had from 10 years ago, or, whatever it is. And so, there's sometimes that we make some discoveries. Now, the other way of pulling credit is called a soft pull. A soft pull is very similar to what Credit Karma does. So it doesn't affect your credit score every time you refresh Credit Karma. What it does is that it doesn't really leave a mark or a record on your report. It just kind of takes a snapshot, like you're taking a Polaroid picture. It just takes a snapshot, lets us see what that score is, all the same information. Okay. So the important thing is that, whenever you're working with a lender, ask them, because they're gonna have to ask you, can I have permission to pull credit? It's called a credit pull authorization. That's by law. Everybody has to receive that. But the follow-up question that you want to ask is, are you going to be doing a hard pull or is it going to be a soft pull? And preferably nowadays, the lender, whoever it is, only does soft pulls or only needs a soft pull, when pre-approving you. Now, once we're underwriting, when the bank is evaluating, we may have to do a hard pull, but at least then you're on your way to buying a house. Right now we're just kind of exploring and discovering, right? So there's a hard pull and a soft pull. So just make sure you know the difference.
Yeah. Okay, I have a question. Now let's say I'm interviewing multiple lenders because I'm a due diligent person and I'm gonna go to 5 different banks or 5 different people. Am I gonna get credit pull on each one and a ding on each one? How does that work?
Yes, it can be, and it doesn't have to be that way. Okay. So if you walk into a bank, a brick and mortar bank, and you do a pre-approval application, you go to another credit union, maybe to another retail lender, then they're probably gonna all do their own individual credit report pull. They're gonna pull their own credit reports because they have their own credit reporting vendor that they use. As opposed to the other way that you can go about things is working with a mortgage broker like myself. So we're the middleman, right? So we deal with the banks, you deal with us, and we'll do one soft pull for you, and we'll be able to use that and basically copy and paste it at all the different banks, and we'll be able to price at all the different banks. So that's the difference between walking into a retail location and then working with a mortgage broker like myself.
I think you need a new title. It's mortgage concierge.
Mortgage concierge, love it.
Just a broker.
Yes. Yes. So yes, from today I shall be the mortgage concierge.
New handle coming in.
Coming in. But yeah, so there are multiple ways that you can go about it. It's kind of like
a matchmaker though. That's what you do. You take the story, you take the fact finding, and you say who's the best fit and the best price. Because you are price shopping for the consumer. That's what you do.
Correct. So yeah, I do the heavy lifting. I do the shopping. And then my job is to also filter all that industry lingo that gets thrown at you and then make sure that it's in a digestible format so that you can understand, if you're being approved, why you're being approved, or, what the terms are. If you're being, declined or, denied credit, being able to explain why that happened. Whereas the bank might just send you like a letter and saying that, oh, your application was denied or declined, right?
Googling why did I get denied? Yeah.
Exactly, right? So, that's what I do and that's what I specialize in. And there is a stark difference between walking into a bank and a retail lender as well, as opposed to a mortgage broker. And a lot of the times the rates that I get is a lot cheaper, is a lot lower than what the banks can offer. So that's another advantage.
Well, I would just say another perk of working with you is that you have experience working for retail side, right? You used to work for the bigger bank and now you work for yourself.
Yes.
And so you have experience, and there's so many hidden fees and stuff that the consumer has no idea. Like if you're watching this video, we have no idea, right? We're on ground zero. We're just trying to figure out what is step 1, what is step 2, let alone analyze an entire list of fees that are sometimes negotiable, sometimes locked in. And working with Brian, he can actually call out the BS on these a lot of the time. So I think that's a huge other perk.
Yeah. And, a lot of the times what I do is that, I encourage my clients to shop around and go see other banks and other lenders just so that they can have a baseline, right? With the service that I provide, the insight that I can provide versus what someone else can provide. And then we can do an apples to apples comparison and truly see, which one is a better deal. Because sometimes, it can be so, looped around and twisted and all this stuff that it gets really confusing that, you want that professional third-party neutral expertise, almost to be able to say, hey, this is what you should be focusing on. So yes, now therefore I am the mortgage concierge. But going back to credit, right? So again, we look at the credit score, okay, and there are some minimums that we want to see. Now, the credit score that we pull on FICO 2, 4, and 5, the mortgage scores, it tends to be a little bit lower than what people are used to seeing on Credit Karma. And again, back to that whole conversation about the different scoring models. So it's not that your credit dropped, but it's the fact that we're using a different algorithm and scoring model to derive those points. So that's why there's a difference, okay? Now on top of that, we look at late payments, collections, all that stuff, the credit history, and that's how your credit worthiness is determined by the bank. Typically for conventional loans, meaning your regular mortgages, the minimum that banks require is a 620. For FHA, VA, we can get lower than that. A lot of the banks, will kind of draw the line at 580 minimum. Some banks will allow for lower than that. And obviously the higher your credit score goes, the better pricing and interest rates that you get. Now, once you hit around 740, 760, 780, then you're really not gonna see that much of a difference. So I have sometimes clients that are like, oh, I have an 810 FICO. I was like, that's awesome. You did really good at managing your debt really well. And they, refuse a hard pull on the credit because it might go down by 3 points, okay? Anything above 780, whether it's a 781 or 810, it's gonna be the same tier because we look at it in tiers, right? It's usually about 20 points every tier. So 720 to 740, 741 to 760, kind of like that. So it's in 20-point tiers typically. And so, anything above 780 is excellent. Good job. If you have a 780 plus score, you did really good.
The way I think of it too is kind of like being a good student, right? So you get an A grade, a B grade, C, D, right?
Yeah.
Even C is passing technically, but it means we might not get the best rewards from it. But you also, through this whole process of checking credit, you're showing that I'm a good person, good responsible person. I'm proving it with my history, right? It's like your track record.
Yeah.
And so again, we're trying to convince the bank that I'm worthy of this big fat loan, like the most expensive thing you're ever gonna buy. That's what we're doing.
Yeah, your track record, your past is the best indicator of your future behavior.
Yeah.
And that's what the banks are looking at. Now, let's talk a little bit about if you did have some dings, because I remember when I was in my 20s, I remember my credit score going down to like 512. Like I really messed up, because what do? You go to college,
and then on going to bars, $100 a night,
exactly. And then on college campuses, these banks come onto your campus and they're like, oh, sign up and get $20 for free, gift card and this and that, and you're signing up for credit left and right without really having that proper education on how to budget and to manage your money and all that stuff. So you just think it's kind of free money and you kind of overspend. And then you're like, whoa, how can I fix this? And the damage that you can cause is a lot easier and faster than the time and effort it takes to repair it. But there is a way to repair it. Okay, so I'm not gonna go into too much depth about that, but just know that, don't give up just because you had some blips in your credit history. It doesn't mean it's game over, it's the end of the road. There's things that we can still do, and that's why it's really important to strategize early on and know what your financial situation is.
Yeah, how long would you say on average it takes for someone to repair their credit?
It'll depend on the degree of repair that's needed, but I say typically at the minimum 3 to 6 months.
Which isn't forever. Again, if we're working on that 2-year plan, absolutely you can do a little bit of help,
For sure, yeah. And realistically, maybe 6 to 12 months, But it's also about learning new spending habits, maybe saving habits, maybe, and maybe it can be as quick as, and I'll give you a quick example. I had a client, we closed this past year, and they were moving to Hawaii from the mainland, and they decided, rather than taking the plane over, they decided to take a cruise as a family from California, and that's how they were gonna come to Hawaii. And they put everything on a credit card.
Wow.
Right? But as soon as they landed, it was time for them to buy a house because they had work starting, school starting, all that stuff. So, that's what their plan was. But because they had maxed out their credit cards, their credit had dropped during that time. And I was like, well, you're not getting the best pricing, and from the buyer's standpoint, their perspective, they were like, oh, I'm a 740 kind of guy, what do you mean, I can't get the best pricing, right? Yeah. It's because, they had maxed out their credit cards, so we had to figure out a quick plan on how they can pay down their credit cards, things like that, do some quick first aid on their credit. Their credit went from, I think it was like 660 all the way up to 720 within 30 days. Wow. Yeah. And then we were able to get that better rate, that higher credit score, the lower interest rate. So now that we've kind of talked about credit, not the evil twin, but just the other twin, right? The other side of the coin is going to be your debts. Yeah. Now, when we look at your credit report, we don't look at how much you're actually paying every month. So I know some people like to pay extra on their car loan, extra on their student loan. That's not what we're looking at, but we're actually looking at the minimum monthly obligation for each line of credit or loan, okay? So if it's $35 a month, that's all we need to know. If it's $100 a month, that's all we need to know. Yeah. Sometimes, especially if you're on deferment for a loan, student loans are still deferred right now and showing zero. For when it's showing zero, then we actually have to calculate a payment, and it's typically 1% of the loan balance. So if you have $12,000 in student loans, even if it says zero on your credit report, we have to manually calculate $120 and just still hit you for that. Now we have to tally all those monthly minimum payments up, and then we also tally up the future mortgage payment that you might have, right, that we're trying to get, and we add that together. And that number cannot exceed 50% of your before tax income. Okay, so let me break this down really quickly, okay? Let's do an example. So let's say your before tax income is $10,000. You're on a $120,000 annual salary, okay? So before tax income is $10,000. Then I will multiply that by 50%. So that's $5,000. So that means that your car payment, your student loans, your credit card minimum monthlies, and your mortgage payment, HOA dues, anything that has to do with housing, all added together cannot exceed $5,000. Okay, so that's how we look at it. And that's what we call your DTI, also known as debt to income ratio. This is a very important term that you're going to be hearing a lot as you're speaking with your loan officer. Those two pillars are going to be probably the most important things, your income and your debt to income ratios, and that's derived by knowing your credit and also your debts. So those two pillars are the two probably most important pillars. Now, that's not to say the other pillars that we're going to talk about are not important, but those are the pillars where usually we can get a sense of, can we qualify you, or can we pre-approve you, or do we have to wait a little bit?
Yeah, and I think it's a really good tool to just use as pencil math, like, right? Take out a scratch paper napkin and just say, this is how much money I make every month, and then this is what my monthly payments are that are debt considered. Add them all up. Where are we at? What percentage of the income am I at?
Yeah.
That's just quick paper math.
Correct.
Yeah.
And then depending on the different loan type, that ratio of your debt to income ratio, there's different thresholds. So for conventional loans, your regular mortgages, it's about 50%, technically 49.99. So 50%. For other types of loans, it might be like 53, 54%. Okay. For VA loans, it could go up to sometimes 65%. Okay. But you know, if you're thinking about 65% of your before tax income, that's pretty much your whole paycheck.
Yeah.
You know, so, you know, we definitely want to see other sources of income that we may not be able to qualify for or you put on paper, but, you know, we want to just make sure that there's other sources of income. And a good loan officer will tell you, hey, I'm concerned about this monthly payment. Most loan officers will try to say, hey, you qualify for this, you should get, you know, you should buy a $1.2 million house, right? But a good loan officer will tell you, this monthly payment concerns me a little bit. How does it feel for you?
Yeah, absolutely.